Big storm is brewing. U.S. one-year sovereign CDS soared to 106 basis points, a new high in 2008. Credit default has soared. U.S. Monetary Fund flew more than $70 billion in a week, and the U.S. stocks will be the highlight. A debt ceiling debate continues to raise market concerns as traders are pricing the risks of a U.S. debt default. The pricing of one-year U.S. sovereign CDS has surged to 106 basis points this week from the 15 basis point at the start of the year, the highest since at least 2008 and even above the critical moment when the U.S. sovereign credit rating was downgraded in 2011. The Financial Times said, citing Bloomberg data, at the time the standoff over the debt ceiling led the S&P 500 downgrade its credit rating from 3A to A+, and the one-year sovereign CDS to above 80 basis points in a week. Like the current situation, the government had stalled talks to raise the maximum federal borrowing limit. Analysts said the U.S. government's deadline for raising the $31.4 trillion debt ceiling could be earlier than expected, pushing up the risk of a debt default, which could have a broad impact on global financial markets. Derek Halpenny, head of global market research at Mitsubishi UFJ Financial Group, said in an email sent to the National Business Daily, given the political differences in the U.S., the current debt ceiling is very similar, and if even worse than in 2011. Yields on the 3-month Treasury notes surged to a 22-year high this week. The CDS derivative acts similar to insurance. If a company or country cannot repay a loan in the bank for the next 12 months, the CDS holder is compensated, so it can be used to measure the market expectations of a debt issuers to default. The surge in one-year U.S. Treasury sovereign CDS, the report said, highlights that investors are taking action to guard against the risk of default from the U.S. government. Although the possibility of a default is still low, analysts also said that one-year swap market is relatively small in size and was poor in liquidity. But analysts at ING said even though the countries with the highest credit ratings typically have CDS transactions, if only between 25 basis points and 50 basis points. Antonin Bova, head of European interest rates, said, the market clearly believes that the risk default in the US is much higher than in the most of other countries. He added that the equivalent CDS in Italy, the UK, and Greece are currently only 39 basis points, 14 basis points, and 46 basis points respectively. Some analysts, according to Reuters, there's a premium on some treasury yields, which may also be related to the higher risk of U.S. default. According to Reuters, on Thursday, the yield on 30-month Treasury bonds hit 5.318%, a 22-year high. Treasury Secretary Janet Yellen also said in January that the federal government would default if members of Congress did not raise the U.S. debt ceiling by June. When asked about the potential consequences of a debt default, U.S. President Joe Biden was also blunt about it. He had said in January that a default on the country's debt would be a disaster, more than any financial event that has ever happened in the United States. Moody's chief economist said the U.S. debt default could have a catastrophic impact on the economy and endanger millions of jobs. In addition to the one-year period, the 5-year U.S. sovereign CDS has also soared. In addition to one-year sovereign CDS, the price of the 5-year sovereign level of the U.S. CDS, the most widely traded form of debt insurance, also hit a record high of more than 50 basis points this month. The National Business Daily noted, when the debt ceiling was lifted in January, the 5-year sovereign CDS hovered around 35 basis points. Derek Halpenny, head of global market research at the Mitsubishi UFJ, said in an email to the National Business Daily that focus will soon shift from the Fed's monetary policy to U.S. debt ceiling. As our study shows, the 5-year U.S. sovereign CDS has soared to new highs since 2011, while the 10-year Treasury yield remains in the range of 3 to 4%. We believe that the current debt ceiling context is very similar, if not worse, than in 2011. Given the U.S. political divide, U.S. politicians dragged the debt ceiling talks to the last minute, leading to a lower credit rating and a sharp rise in the interest rates. While it is too early to begin to expect a U.S. government default, that is still what we will focus on in May. In addition, the government's lower-than-expected tax revenue in April added to concerns about defaults. Danske analysts said the Treasury's current cash balance is about $250 billion, which means that X could arrive as early as June, much earlier than previously expected from July and September. Goldman Sachs analysts estimate that the Treasury could move to the debt ceiling deadline forward to early June if the final data show a 35 or more and tax drop in April over the same year. But if the decline is less than 30%, a late July deadline is more likely. Earnings season was mixed with whether technology stocks could unbalance the market. After the start of the new financial quarter, the U.S. stocks are basically in a narrow range of the state. Investors digested a series of mixed earnings and reports signs that the risk of a recession rose as interest rates at nearly 15-year high began to cool consumer demand, further casting the Fed's monetary policy outlook. In the coming week, technology stocks represented by Google and Amazon will report earnings, and whether the best-performing sector this year continues to extremes will be the key to breaking the current market calm. The data is hot and cold, but the overall rate hike is set. After the banking turmoil, the outside world is watching closely whether the U.S. economy will be hit. Several data show a deterioration in the U.S. economic fundamentals, such as the Conference Council's leading index fell for 12 straight months in March, the lowest level since November 2020. Meanwhile, the labor market was volatile, with initial jobless claims at their highest level since November 2021. In the week through April 19th, total credit through the discount window and relief program reached $143.9 billion, up $4.4 billion from the previous month. But the latest Purchasing Managers Index reflects that the U.S. economy has not receded across the board. Data shows that services PMI rose to a one-year high of 53.7 in April from 52.6 previously, while manufacturing PMI returned to expansion territory after a half year, and the stabilization in employment and demand is expected to continue to keep business activity alive. In its latest comments, the Fed is preparing for a May rate hike. New York Federal Reserve President William Williams, a key member of the Federal Open Market Committee, said last week that inflation pressures on services, key inflation indicators that the Fed is focusing on, remain unchanged. He reiterated his previous view that the Fed would need to raise rates by another 25 basis points next. Fed Governor Lisa Cook said a number of indicators have passed their peaks but remain high, indicating inflation has taken wide root in the economy. Hawkish member and Cleveland Fed Chairman Loretta Mester says the Fed's benchmark federal funds rate rose to more than 5%. Money funds suffered a big sell. U.S. stocks have traded in a tight range over the past week, with the three major indexes saw around the upper track of their trading range for the past 5 months. As of Friday, more than 75% of stocks have earnings that beat expectations, while analysts maintain their expectations of S&P 500 quarterly profits falling nearly 25% year-on-year, according to agency statistics. Money flows also show that investor sentiment remains cautious. U.S. equity funds saw a net outflow of $1.51 billion in the weekend April 19th, as the Fed was expected to continue raising interest rates to respond to inflationary pressures. According to financial data provider Lipper, it's worth noting that after 5 straight weeks of combined net purchase of $346 billion, money funds hit net redemptions of $71.66 billion. Thank you for listening. Don't forget to subscribe and like. See you next episode.